Hi, everyone. Welcome to the Weekend Charts, where I run through the most interesting charts and themes in markets and investing. Another big show for you this week, a lot to discuss. Today's show is brought to you by my friends at YCharts, awesome data analytics charting platform. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So I want to start out today talking about the inflationary spiral, which has unfortunately continued here in the U.S. We have the inflation rate now at 8.5% over the last year. That's the highest we've seen since 1981. So you have to go back over 40 years to see an inflation rate in the US this high. And what's the big difference between back then and today? Well, it's really Fed policy, monetary policy. So in the early 1980s, Paul Volcker was the head of the Fed. He was tasked with breaking the back of inflation, doing what he needed to do to bring inflation down, and he drove interest rates all the way up to 20%. It seems unbelievable given today's standards, but that's what he did. Ronald Reagan gave him the leeway to do what he needed to do, knowing that it would probably cause a recession, and indeed it did. There was a recession in 1980 and then another one in 1981 that lasted until 1982. Inflation then did come down. It hasn't been a problem since then until today. But here we are today, 8.5%. And where's the Fed funds rate? Well, it's still close to zero. The Fed's only hiked one time. And really, their opinion has been up until this point, well, it's going to come back down. It's transitory. Easy money should be the status quo default policy. And they've really ignored one half of their dual mandate, which is to try to maintain price stability. But I think that narrative is changing. I think the Fed understands now they're well behind the curve, and they're going to have to hike rates aggressively in the months to come to try to bring inflation back down. So where are prices rising? Well, pretty much everywhere. If we look at the table here, which really shows the breakdown of the major components of CPI, you see just broad-based increases pretty much everywhere. So if we look at energy prices, fuel oil up over 70% in the past year, gasoline 48% increase, utilities 21%, electricity 11%. We have car prices still elevated in terms of used cars and new cars. And a big one here, food at home. So if you've been going to the grocery every week, of course, you've noticed prices continue to go up, now up 10% over the last year. That's a pretty big increase above the overall rate of CPI at 8.5%. And what you'll probably notice down at the bottom here, strange occurrence, is that shelter is showing only a 5% increase over the last year. How is that possible? Well, as we've talked about, the methodology is as wildly understating the true rate of inflation in terms of the housing market. We have home prices up close to 20% in the US over the last year, rents up 17%. So this number is not an actual or accurate reflection of what the average increase in housing is for most people. So if we use the actual number for housing increases, we'd have an overall rate of CPI that is well above 10%. So CPI could be actually much higher than what they're reporting. But in the months to come, if we see that shelter number rise and get closer to reality, we're going to see continued pressure on the overall price index. Why is that? Because at a third of the index, housing is by far the biggest component of CPI. So in terms of how people are feeling about higher inflation, I think this chart is the most important one to look at. It really tells the story. Starting back here in February 2020, we printed a lot of money, we borrowed a lot of money, and initially it seemed like there were only positive effects that were coming from that. People's wages were going up, they were feeling pretty good. But as we've talked about, inflation only comes with a lag. So you do those things, and only with time do prices start to rise. And what we've seen really in the last 12 months is a reversal of all of the benefits that people felt in terms of higher wages and higher prosperity, because that's been reversed. We've had a situation now where 12 consecutive months, the prices in the economy have outpaced people's wages. So we have the bottom chart here showing real average hourly earnings. And now we're incredibly all the way back to February 2020. So we're back where we started despite all of the stimulus efforts that went into it. And if we get when we get the April CPI report, we're likely to see this fall further, which means that the average person will be feeling in terms of their wages relative to prices, feeling worse than where we actually started this inflationary spiral back in February 2020. Very important chart to watch. This is the primary reason why the Fed needs to hike rates. They need to get this, or try to get this, under control. You can't have a situation persist. You don't want to see this persist in terms of price increases outpacing people's wages, because that's really a decline in prosperity. That's a lower standard of living. And so you need to get inflation under control, and hiking rates is going to be one way that you do that. And we'll talk a little bit about how the Fed is going to do that, how much more aggressive they're going to be in the months to come. So if we look at expectations in terms of inflation, it's very important. So I put this poll out on Twitter asking, what will the inflation rate be over the next year? So we've had this 8.5% increase, highest since 1981. Do people feel like it's going to come right back down? What do they think going forward? If you look at the breakdown on the chart, I think most people believe that it's going to stay above average going forward. So remember, before the pandemic, we were averaged around 2% in terms of inflation for the 20 years prior to the start of the pandemic. And now, since then, we've seen highest rates of inflation since the early 1980s. People are thinking that that's going to continue. 35% of people said that inflation is going to be above 7% over the next year. You have almost an equal number saying 5 to 7% and 3 to 5%. So any way you look at it, people are expecting prices to continue. Why is that important? Because part of the psychology in terms of price increases is people's acceptance of it. And when they think that prices are going to go up over the next year, there'll be more acceptance of paying higher prices going forward. So it's kind of circular. But if people are expecting higher prices, they're willing to pay higher prices. And so prices, all else equal, will be above where they would otherwise be. So inflation expectations, you want to see that to come down. And the Fed is obviously watching this data closely in terms of the market-based inflation expectations, in terms of consumer expectations as well. So this is an important factor. We'll see if these turn out to be correct over the next year. But I would point out that they've been right so far. So I did this poll last May and June asking a similar question. Do you think these elevated rates of inflation will continue? Most people said yes. While at the same time, the Fed and the Treasury were saying no, inflation was going to come right back down. That ended up being the wrong expectation. And so the average person has had a better handle in terms of what inflation is going to be going forward than the Fed or the Treasury. So how do you protect yourself in terms of inflation as an investor? So there's a number of different ways you can do that. We've talked about, in the long term, the best inflation hedges have been stocks and commercial real estate, so REITs. Those have produced the best inflation adjusted returns, let's say, over the last 40 years. So over a very long period of time, your best hedge against inflation is simply owning stocks or owning commercial real estate, or REITs have been by far the best. Now, in stagflationary environments like we saw in the 1970s and perhaps we're in today, commodities can be very helpful in the short run. So things like oil and gold and other commodities will tend to outpace the level, or at least keep up with the level of inflation during those periods of time. And so if we look back when this inflationary period really started, a little over a year ago, commodities have far outpaced the rate of inflation. So they've been a pretty good hedge. But in terms of your bond exposure, is there a way to protect against inflation? A lot of people talk about tips, but the downside with tips is they are subject to principal changes. So when interest rates rise very rapidly, as they have been, tips can actually go down. They'll do better than treasuries of the same duration, but you still have the case where tips are actually negative this year despite rising inflation. Is there another way that you can protect without that principal volatility, without that principal risk? Well, there is this vehicle that I've talked about in the past, but I want to touch on again, called I-bonds. And I-bonds are an interesting vehicle. They're a government savings bond. You can go to Treasury Direct website, treasurydirect.gov, and look up all the details there. But basically, it's a vehicle that's been earning 7% over the last 6 months. So the components are you have a fixed rate of return, which is zero, and then a semi-annual rate of inflation that changes every 6 months. And so for the past 6 months, it's been 7%. But I just ran the calculations, and starting in May, they're going to use the last 6 months through March. So you're going to have a 9.6% annualized return for these bonds if you buy them in May. Very, very interesting. You're getting close to 10% return for these bonds for that 6 month period. So that's an annualized rate of return and essentially risk-free. So what are some of the features of I bonds I want to run through very quickly? You have that fixed rate component plus that inflation rate, which changes over time. So if inflation goes up, you'll be protected. If inflation goes down, you're going to earn a lower rate than today. But as long as it's positive, you're still going to earn some return. What if inflation turns negative? What if you have prices go down? We've seen that from time to time during brief periods. There's a floor on these bonds. So for that period of time, if inflation were to be negative, you just earn zero on the bond. So that's a positive as well. How long do these bonds last? Well, you can hold them for as long as 30 years. They have a 30-year maturity, but you can redeem them after 5 years without a penalty. So if you have 5 years or you're looking at something where you want to have that bond exposure, you don't want to have principal volatility, this is something to look into. What if you needed to cash it in before 5 years? Well, you can do it after 1 year and just give back 3 months of interest. So just taking the last 3 months, the most recent 3 months of interest, you'll lose as a penalty if you need to redeem it before 5 years. Some benefits of these bonds as well is their interest is tax deferred. So you don't pay tax every year on the interest you earn, only when you redeem the bonds. So you could really hold them for 30 years and only pay interest on that at the end of that 30-year period if you wanted to. Another positive is they're exempt from state and local income taxes. So you're only paying federal income taxes on the interest. So if you live in a high tax state like New York or California, where taxation rates can be very high, this is another benefit. And in terms of how much you can buy, there is a limit. Unfortunately, it's only $10,000 per person per year. So you can't put a ton of money in this vehicle. But again, it's something, it's to be treated as like an alternative to a risk-free bucket that you have in your investment portfolio, where you don't want to take principal risk and you're really worried that inflation is going to persist for years to come. This is a pretty good vehicle. And so if you want more information, go to that treasurydirect.gov. There's a lot of good information there. But this is just an interesting way to get, for at least the next 6 months, close to 10% annualized return on your money and really protect against the possibility that inflation is going to be high for years to come. So what is the Fed going to do? As we talked about, they have to do something. It's becoming more and more ridiculous if we look at Fed policy versus the inflation rate. This chart tells you everything you need to know. It's the Fed funds rate minus the CPI rate. So Fed funds rate minus inflation. And we haven't seen a negative rate this low in terms of the real Fed funds rate. You got to go back to 1974. There's only a single month back then where it was lower than it is today. So totally disconnected with reality in terms of Fed policy. But as we've said, this is not going to persist. This has to change. And now the expectation is that the Fed's going to be much more aggressive in the months to come. So what is the market expecting? If we look at Fed funds futures, and remember, the Fed pretty much over the last 12 years has followed what the market expectation is to a T. So if the market's expecting a 25 basis point hike, they'll hike 25 basis points. If the market is expecting a 25 basis point cut, the Fed has cut 25 basis points. And if the market is expecting the Fed to do nothing, the Fed does nothing. So if the expectation is 50 basis points going into that May meeting, I think there's a pretty high likelihood that they're going to hike 50 basis points. And if we look at the Fed rhetoric in recent weeks, you have Powell hinting at a 50 basis point hike. Just this week, you have other Fed members doing so as well. So it seems increasingly likely that at least in that May meeting, we're going to get a 50 basis point hike. But the market expectation is not just in May, but also in June, 50 basis point hike at least. And in July as well. So if these expectations are correct, we're going to see a Fed funds rate of close to 2% just in 3 months' time. By really close to the end of July, we're going to see a much different picture in terms of the Fed funds rate. And so in next week's video, I'm going to talk about If you're a saver and you're looking at savings account, we've talked about I bonds. But what should you be doing if you're still earning nothing on your savings accounts or in your checking account? Is there ways to participate in this rate increase? Yes, there is. So we'll talk about that next week. So what's been the downside in terms of the rate hikes? Well, for bond investors, it's been very painful. This is now the longest correction we've seen in the U.S. bond market in history. It started in August 2020, 621 trading days and counting. 621 days actually and counting. And we have the Barclays aggregate down over 11% now. That's the biggest correction we've seen in bond market since the early 1980s. So you have to go back a long, long time. And this is, again, the longest correction we've seen in bond market history. So the pain in terms of the bond market is due to this rise in interest rates. So we started out here, August 2020, 52 basis points in terms of the 10-year yield, all-time lows, right? And since then, we've seen the 10-year treasury yield rise. We're all the way up to 2.92% today. And that increase in interest rates when you're starting out from such a low level causes just a big price decline. And we've seen that really accelerate this year. So this bottom part here shows you the U.S. aggregate bond ETF, AGG. It's now down over 11% since August 2020. So higher interest rates, lower bond prices, that's the relationship you get in the short run. But in the long run, what do higher interest rates mean for investors going forward? Well, it's actually a good thing. So this is the chart showing you the relationship between the beginning yields on bonds and their future returns. So really broken down from the highest starting yield to the lowest starting yield over here on the right side here. And these are their future returns for bonds over the subsequent 7 years. So when interest rates have been at their highest levels, you've seen the best returns going forward. When interest rates have been at their lowest levels, you've seen the worst returns for bonds going forward. So if there's a reason to be optimistic in terms of the bond market, if you're haven't been in bonds, you've been just holding cash or short duration securities in the bond market, now you're at least getting some yield on your bonds. Again, it's not a super high yield given the rate of inflation, but we're at close to 3% in terms of a 10-year treasury yield. So a reasonable expectation, if you're looking out 7 years from now, would be something getting closer to that 3% level, which, again, given 8.5% inflation is not a super high rate, but at least it's something. So the more interest rates go up, the higher your expectations should be for future bond returns. It tells you nothing about bond returns over the next 6 months or 1 year because interest rate changes in the short run dictate everything. But if you're looking at years from now, 5, 6, 7 years, that starting yield is a pretty good approximation of what you're going to get. And that makes sense because of the bond math. Basically, if you hold that bond to maturity, you're going to receive that yield over the lifetime of the bond. But in the interim, that changes in interest rate is really going to drive things, especially in the short run. So the good news for bond investors is returns going forward going to be better. Bad news is yields still aren't very high just yet. They're just higher than they've been. And so at least you're getting something on your return for bonds. And so hopefully, the relationship between inflation and interest rates will kind of narrow by inflation coming down. And that yield, that close to 3% yield on a 10-year will look better. We obviously don't want the situation where inflation stays elevated and bond yields continue to rise going forward. That's going to put additional pressure on bond market returns. But as we've said, when it gets to the point where interest rates are super high, well, regardless of what interest rates do from there, you're going to be earning that high level of coupon. So you just have much more cushion the higher the starting rate of interest rate is. So if you have an interest rate of 8, 9, 10%, you're just much more protected against changes in interest rates. So even if interest rates rise there, well, you're earning such a high coupon that you're gonna make your money back much quicker. So unfortunately, we were starting here from such a low yield in August 2020 that there was no cushion for that rise in interest rates. But here we are today, a better place for bond investors. But let's talk about the housing market and what's been going on there. As we've discussed, it's really been a housing boom that's really been unparalleled, with the exception of the housing bubble in the mid 2000s. We got more data on that this week. Existing home prices, we look at median sales price. We have another record high there, up 34% over just the last 2 years. And why is this alarming? Well, people's incomes, of course, haven't gone up that much in the last 2 years. And unfortunately, mortgage rates now are skyrocketing. So the affordability for the average new entrant into the housing market has really plummeted. So if you're looking at a home for the first time, you just have to pay a much higher down payment than you did a year ago, 2 years ago, for two factors. One, mortgage rates have skyrocketed, and two, home prices have gone up significantly as well. So here's the chart: 30-year fixed mortgage rate. We keep showing this, but it keeps going up. So I gotta keep talking about it, because it's really something we haven't seen in a long time. We're at 5.11% now on the 30-year fixed is the average rate. If you have a lower credit score, we're going to be looking at a even higher mortgage rate than this. But really, in the past 16 weeks now, we've seen a 2% increase. So we were at 3.1% just 16 weeks ago. Now we're at 5.1%. That's the biggest rate of increase we've seen since 1980. So you got to go all the way back to 1980 to find a bigger increase in mortgage rates over a 16-week period. And importantly here, if we're comparing mortgage rates to where they were back in 2010, well, now this is the highest rate we've seen since 2010. But the problem, of course, is the home price in the US has more than doubled the average home price over that period of time. So again, this is going to likely hit demand. There should be a housing market slowdown at the very least, and possibly a bigger correction coming in the months and years to come, just to really normalize things, because you have the situation where incomes now are extremely stretched in terms of their relation to home prices. So if we're looking at home prices as a multiple to incomes, we're at the highest levels we've ever been, and that includes the housing bubble of the mid 2000s. So in terms of the stock market, are investors pricing in a slowdown or correction in the housing sector? Yes, I would say. This is a chart showing you the U.S. home construction ETF, ITB is the ticker, down over 30% from its high. So we're seeing the weakness. Investors are pricing in, at the very least, I would say, a slowdown in the housing sector this year, which is really driven by two factors: one, rising interest rates, and two, by that affordability factor. And if we're looking at things like inflation, it's not in a vacuum. So if people have to spend more at the pump, for their utility bills, at the grocery store, well, they're going to have less money to put into their home. They're going to have less money to put for a down payment, and so on and so forth. So that higher inflation rate really crowds out spending, discretionary spending elsewhere, whether it's travel, entertainment, or putting money into your home, which has been a big factor in terms of the economic recovery that we've seen, since the pandemic lows. So let's talk about some stocks now. Netflix, big earnings report this week. Unfortunately, not a very good report for Netflix. This was the slowest rate of growth if we're looking at revenue for Netflix. We got to go back to 2012 to find a number that was below 10%. So obviously Netflix has been one of the great growth stories in history for US stock market, one of the best performing stocks in the S&P 500 over the last 20, 30 years. Netflix is on a short list of those companies that have really outperformed almost everything else. But as we've talked about, there's no upside without downside. And now we're in that period where Netflix shares are being repriced. And so if we look at drawdowns, this is really give you a picture of where we are. It's lost 2/3 of its value, Netflix, since its peak last November. And what's driving that? It's really a multiple revaluation. And so this chart tells you that story, because we have Netflix revenues in the last 4 years doing pretty well, 138% increase in just 4 years. That's a phenomenal growth, all else equal. But prices are actually down. If we're looking at the stock, 33% over that 4-year period. Well, how is that possible? Well, investors are revaluing the company. So they were trading, buying Netflix at 11 times sales here 4 years ago in April 2018. And today they're only willing to pay 3 times sales. So the question, of course, is 3 times sales cheap? Can it go lower? What's going to happen from here? And let's just take a look back in history. It's hard to predict where this multiple is going to stop. But if we're being objective, the last time Netflix had a growth rate this low, sub 10%, it was trading at actually less than 1 time sales. So can the valuation go even lower? Yes. We've seen bigger drawdowns in terms of Netflix stocks. So it went down over 80% over here when growth really slowed during the last time. So could that happen again? Of course it could. Valuation can always go lower. This is a theme that we've talked about with many of these high growth stocks where it seems like, well, it was trading at close to 15 times here. And just last November, you're at over 10 times sales. So now it's at 3 times and it seems like it's cheap. It's certainly cheaper than it was, but valuation is really a function of sentiment in the short run. And if investors get extremely negative on Netflix going forward, then they could bring that multiple even lower. So the big surprise, at least in the report, was that Netflix subscriber growth was negative for the first time in the company's history. So they actually lost subscribers for the first time. And they're forecasting in the next quarter to come, even bigger losses. So I think a few million losses in terms of subscribers. There's a number of factors that they pointed to driving that, increased competition being a big one. But that's just something that this company hasn't seen. We've just seen nothing but growth in terms of subscriptions to Netflix. And so this is a different period. This is a period of transition. The company is going to have to figure out different ways to drive revenue and to drive profitability other than just growth in subscribers. And so will it reprice? Will the repricing continue? We don't know. But certainly it could. And I want to use Netflix in terms of the story of Netflix, contrasting it with other areas of the market that have been doing very well. It's really been a reversal of fortune here in terms of the energy sector versus Netflix. So here's a chart showing ExxonMobil versus Netflix, their market caps over the past few years. As you can see, this is during the initial stages of the pandemic. You just have ExxonMobil crashing. Netflix, of course, went down at first as well. But you have just a complete repricing in terms of the energy sector. Remember, crude oil went negative here in April 2020. And then at this point, later in 2020, Netflix actually had a market cap $100 billion higher than ExxonMobil. And from there, you would see Exxon recover. Of course, crude oil prices would recover. And really the big divergence here happens at the start of this year where ExxonMobil takes off. We know crude oil prices are up significantly this year while Netflix has really collapsed. So what does the chart tell you? Well, investors can change their mind. Nothing is static. Investors can be very fickle in terms of what they'll pay for a security. And when growth is very high, like it was for Netflix for years, they can pay an elevated multiple and they can become overly depressed in terms of things like ExxonMobil when it seems like the outlook is most bleak. So never assume that things in markets will continue as is. Markets are always changing and trying to price in those future expectations. As the story changes, this will change as well. So what will this look like a year from now? I don't know, but it's probably going to look different than it does today. So the market's always giving you surprises like this. So if we look at the market broader, if we look at something like the NASDAQ 100, this is an important chart. As people keep asking me, are stocks cheap now? Are tech stocks in particular cheap? Because we've seen the biggest correction in terms of the NASDAQ that we have in some time, 20% this year at the lows in March. And I think this is an important chart to tell you that stocks aren't actually cheap if we're being objective. So this is a chart showing the median price to sales ratio of the NASDAQ 100 company. So we started out 10 years ago around 3 times sales. We went all the way up to 8.5 times sales. And during that 20% correction, you got down to around 6x sales. So 20% correction means stocks are cheaper than they were when that started, but they're not cheap if we look at any other historical period, if we're looking back the last 10 years. Now, the mistake I think people made during this valuation expansion here was in saying, well, interest rates are so low and therefore any valuation is justified. And I think that was a mistake for two reasons. One, if we look at the historical record, there's very low correlation between interest rates and valuations. So if you go back in time, very little of the relationship in terms of valuation is explained by the level of interest rates. So people were, inventing that story as a way to justify paying such a high multiple when it wasn't actually even rooted in the data. And number two, the bigger problem with that, as I talked about a year ago, was that if you're buying a security at a high multiple because you say interest rates are so low, then you have to ask yourself two things. One, what happens if interest rates rise, of course, because then that multiple might come down under that logic. And two, well, what if interest rates don't go anywhere? So you need not only that interest rates won't rise, but you need them to keep going down even further to drive a further multiple expansion. So you have a number of problems with the logic of buying an asset based on a very low interest rate at a high multiple. And so here now we have the data. It's pretty clear. The NASDAQ 100 is trading, the median company is trading around 6x sales today. The 10-year treasury is getting closer to 3%. But if we look back 10 years ago, when the median company was trading at 3x sales, you had the 10-year treasury at around 2%. You had a Fed funds rate at 0 back then, and the Fed wouldn't hike rates for 3 years. So we have this interesting scenario. If you still believe that low interest rates are the only factor driving valuations, or interest rates in general, should be pointing to exact valuation number here, it's pretty clear. We had a much lower interest rate back here in 2012, and the valuation was half of what it was today. So really important chart, because it tells you that valuations could still go lower, right? Yeah, regardless of what happens to interest rates. So if this ends up being a bigger bear market like we saw from 2000 to 2002 and 2007 to 2009, you're going to see that further multiple compression in the median NASDAQ 100 company. So let's end here talking about Twitter funding secured in terms of Elon Musk has said that he has $46.5 billion in committed financing, $25 billion in debt, $21 billion in equity. And he's hinted on Twitter about doing a tender offer. And then he came out with the filing that says that he is likely to do so. And what does that basically mean? They're going to offer right directly to the shareholders an offer to purchase their shares, likely a cash offer at that $54.20 price. And we'll see what happens in terms of the board. They still say that they're evaluating the offer. But if we look at Musk's words here, in terms of the filing, it's probably the first time we've ever seen language like this. He says he's not playing a back and forth game. He's going straight to the end. It's a high price that he's offering. So he's made the case that the price is significantly higher than when he started buying the shares, when he started to take his position. And if he's saying if the deal doesn't work, he's going to have to reconsider his position. So he's playing a game of chess here with the Twitter board, essentially saying, if you don't accept this offer, you don't give it serious consideration, I sell my shares, well, the price is likely to go right back down. You're going to be blamed for not accepting. You have a fiduciary duty to really give this a serious evaluation. Of course, the Twitter board will have to see if there are any other offers out there, better offers than this. But I think he makes a pretty compelling case to say why Twitter should accept this offer. And as we talked about, Musk has made the claim that this is important to free speech, that Twitter has become de facto town square. And by taking it private, it's going to allow him to do things to the company that he wouldn't be able to do in terms of ensuring free speech and ensuring that it continues and people aren't banned from the platform without due process or without transparency as to why that is. So I think it's a good thing. I think that people are in favor of it. The vast majority of people, if the board doesn't give it serious consideration, I think there's going to be backlash. So we'll see what happens to that. We know that they put in this poison pill, which doesn't prevent them from accepting his offer. But what that essentially means is they're just discouraging him from taking, or anyone from taking above a 15% stake in the company, because at that point they'll allow for a dilution of shares. They're allowed for people to buy shares other than Musk at a much lower price, which would dilute his position and really discourage him from taking over the company. And again, they don't have to exercise that. They could still accept his offer. We don't know what will happen. But I put the poll out on Twitter. Do you think that Twitter should accept Elon Musk's offer? And vast majority, 68%, said yes. If we look at the share price, it's still trading well below that $54. So we'll see how it trades. I think if it gets closer to that $54 mark, that will tell you that people are expecting the deal to go through. So a lot of moving parts here. But an interesting thing to watch, of course, and I think overall would actually be a good thing. And he's hinted at making some other big changes in terms of getting rid of the bots and spams on Twitter, which if you're a user of Twitter, you can see that it's really been overwhelmed with these fake accounts and these automatic replies that are really spam and scam, and someone should be able to do something with that. And in terms of free speech, it's something we should all want. Again, as I've said the last time we talked about it, illegal activity is one thing, but a difference of opinion is another. And while we may not agree with each other in terms of our opinions, we should defend each other's rights to have those opinions. Again, assuming you're not saying or doing something illegal on the platform. So I think I have high hopes for Twitter if Musk takes it over. He's proven to be a great operator. Remember, Twitter stock really hasn't gone anywhere since its IPO. The share price has really languished. From that standpoint, I think there's a case to be made that there should be new management. And if anyone's proven they can do something with a company, it's Musk. And I think this is an issue to him that seems to be very important. And it should be important to all of us, again, to have that place where you have that freedom of speech without a company arbitrarily suppressing that in favor of one side or another. So we covered a lot this week. Thanks, everyone, for joining me. Have a great weekend, and we'll see you next week. Thank you.